Traders, how you doing? And welcome to my channel. Hope you're all well and trading safe. Today's video, we're going to talk about two simple tactics you can use to avoid the dreaded fake out. So let's be honest, most breakouts fail, right? They say 70% of breakouts are failed breakouts and only 30% of breakouts continue in that desired direction. So how do we stop getting involved in those 70% and start really getting involved in those 30%? Well, like I said, I use two things. The first is a simple moving average, and the second is what you call accumulation prior to a level break. So let's take a look at them in a bit more detail. Now, the 20 period SMA is obviously an indicator, so it's very easy to add into your charts. We just go to Insert, Indicators, Trend, and then Moving Average. Type in 20. Remember, we're using simple, not an exponential, a simple, and whatever color you want. And your 20 period comes up there. Now, the second part is accumulation. Now, this is not an indicator. This is mainly to do with price action. And the price action we're essentially looking for prior to a break is something that looks roughly like this. We have price moving up to a resistance or a support level and essentially accumulating prior to the break of that area. Okay, so we've kind of got that coiling effect, that load up of positions prior to a break of the area. We don't want to see just a normal breakthrough like that. We kind of want a reload, a loading up a position, that accumulation effect, coiling effect right before the level potentially breaks to the upside, or for a support level, breaks to the downside. Now, if you put these two together, what we're essentially looking for here is using this 20 period SMA, for the 20 period here, plus this accumulation prior to a level, to decipher whether a break will be sustained or whether it will be faked out. So we're looking for that accumulation prior to that level with this 20 period catching up to price, pushing price upwards, because moving averages are known as dynamic support or resistance to price. So we're looking for that 20 period to move up into price action around this accumulation phase, putting a kind of squeeze into this area for a potential break to the upside. Or again, we look at it from the opposite side, a potential break to the downside. So it's essentially about that squeeze into that level, putting more and more pressure into it. For example, if you take a pencil, the more and more pressure you put into a pencil, eventually it will break. So using that 20, using that accumulation to put more pressure and pressure on this resistance level before eventually it snaps to the upside and breaks quite significantly. So let's have a look at the charts and see it work in real life. Now, this is the German 30 chart, which is the German equivalent of the Dow Jones. And the area that we are going to focus on is particularly just prior to the break, right? So these 4 or 5 bars, this is a daily chart, by the way, just prior to the break of this resistance level. Now, as always with every strategy that you employ or every technique, you have to have context as well. But in this video, I'm not going to go into the context prior to this accumulation. I'm purely going to talk about what is happening the few bars before that level break. So if you take this example here, we can see that accumulation or reloading effect prior to this sustained break. So we have 1, 2, 3, 4 days, remember this is a daily chart, worth of price action before we get a very good break to the upside in this German 30. Now, adding on to that, notice how this 20 period is very close to price action before that break. So we don't really taking breaks at this area when prices moved from down here with the 20 period up here, not really close by, no accumulation effect, and that ultimately ended up failing. Now, if you dive deeper into this and focus on this bar in particular, it's a slight hammer bar, slight rejection candle coming around that 20. So that's your indication that the market doesn't want to drop down. It's rejected that area. Price is back above this 20 period moving average, which again is a dynamic support to price. And we've had that 4 or 5 bars of load up accumulation into this level before what ultimately ended up being a great break to the upside, and it's currently continuing as well. Now, here's another example on pound Swiss. This is again a daily chart trade. And we're focusing on the period just before the break of the level. Now, the first thing we can notice here is this 20 period SMA is starting to move up and is obviously very close to price action at this point in time. Great, that's exactly what we want. Remember, we use that 20 period as a guide. We want to make sure that price is not extended going into these levels breaks. Because those extensions, i.e. breaks that potentially move like this, are often susceptible to a snapback, and i.e. a fake out. So we use that 20 period as a visual guide to make sure price is ready to move rather than getting in when it's already moved. So 20 period in this particular example is close by price action. That's exactly what we want. And when price gets back to this level, we can see we've had this period again. You can call this accumulation, you can call it a complex corrective, whatever you want to call it, but it's just that load up of positions prior to breaking through that level. And if we zoom out, let's look at the power that that has had on this particular breakout. So accumulation, 20 period close by, that squeeze into that level, and we ultimately ended up getting a great break because of that. Now this is a Swiss yen chart, and all the examples I'm putting out are very recent examples of this accumulation, 20 period catch up and breakthrough of a level. So we're looking at this area here on the Swiss yen chart. Now notice how, yes, you can call this a squeeze, but this volatility, this accumulation into that area with the 20 period, again, very close to price action. So we don't want to take breaks like this area when there's a bit of gap between price and the 20 period. Or for example here when there's a gap between price and the 20 period. Because normally it likes to correct and retrace back to roughly around that area to again be at the point where it's ready for a continuation on that move. So we had this accumulation prior to the level, we've broken through, had a slight volatility move to the downside, but if your stop was in the correct position, you would still be in that. So in this circumstance, price actually ended up retesting this area. I was actually involved in this trade. This was a winning trade for me. And indeed on that retest, buyers came in and ultimately I ended up hitting my TP1 in this scenario. Price did come back, but again, this was another winning trade, just waiting for that volatility, that accumulation, that 20 period into the level, squeezing price up, and we got our rewards because of it. Now I want to show you an example of why I like this and why I use it in my trading on a day-to-day basis. This is a Euro CAD chart, right? And quite recently, just last week, we saw the Euro break through this resistance area. But look how we've broken through. The 20 period is here stagnant, and we've broken through this area with a massive gap here. And not only have we had a massive gap between the 20 and price action, we've had no accumulation or load up of positions prior to this area to let that move to the upside digest. And what's eventually happened with this is we've completely faked out and moved to the downside. So that's the reason why I like it. It's a very simple thing to see. A 20 period moving average is very simple to add on. Accumulation prior to that level, let that 20 catch up, that squeeze into that resistance or support area before breaking to either the upside or the downside. I guarantee if you're a breakout trader and use this simple method, it'll help you win more breakout trades. Thanks everyone for watching the video. I appreciate it. If you did enjoy it, please hit that sub button down below. It would mean a lot to me and help the channel. Let me know in the comments what your tactics are for avoiding failed breakouts and whether you think this is viable or not. I personally have found a lot of success from using very simple techniques. I'm a massive proponent for keeping things simple in trading, as I feel the simpler it is, the better it works. If you are watching this as a trader and you feel like you want to take your trading to the next level, we offer one member of the website, the link's down below, a free $50,000 FTMO trading account challenge. So one member every single month wins a chance to get a $50,000 trading account on us. So if you're interested in that, the links are down below. If not, I'll see you in the next video. And remember, trade safe. Peace.